Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Tuesday afternoon, we have Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, to discuss if a trend change is possible in the market and some key data and earnings to watch as we go over the next 4 to 5 weeks here. Randy, it's great to see you as always. CPI is out tomorrow. Certainly inflation on top of everyone's mind. What are some potential impacts to the markets could result from this?
Hello, Jill. Great to be back. Well, you know, the CPI is a really important gauge. We got 3 really key inflation gauges, CPI and PPI, which also comes out this week. And then later in another week or two, we get the PCE, which is the one the Fed looks at. But, you know, a lot of people were talking that in the month of May, when we got year over year inflation rate of 8.6%, that perhaps inflation had peaked. But the estimate for tomorrow for this CPI for June is 8.8%, which means it's probably going to be higher. And that means, of course, that inflation has not peaked. Part of the reason for that is that gasoline prices are a huge component, and it's one that really hits people in the pocketbook because everybody needs gasoline. It's not one of those discretionary items, unfortunately. And those prices peaked in about mid-June, which means they're probably going to have a big impact. Now, I think when we get the July data, it's probably going to show the fact that gasoline prices have been falling for the last few weeks. But in June, they were mostly on the rise. I think we could get a nice bounce in the market if we got a lower than expected inflation read. But unfortunately, I'm not sure that's going to happen.
Well, sometimes good news can be bad news as well, because if we do get a lower inflation rating, that kind of, the Fed can remain hawkish and stay within its policy for rising interest rates.
Yeah, the reason I think this is a kind of a period of time where, yes, we've had periods of time where bad news was good news. I think this might be a time where good news would be good news in the sense that we're clearly in a tightening cycle, right? I think it's almost an inevitable certainty that at the end of this month, we're going to get another half-point rate hike, probably even a 3/4 point rate hike. But if we get lower inflation, what it's going to tell us, I think, is that what the Fed is already doing, which is a quarter, a half, and a 3/4 hike so far, is probably starting to take effect. It doesn't mean they're done, but it might mean that they'll start raising rates at a slower rate, or they'll raise in smaller increments in the coming months. And that ought to be bullish for the markets. I think for the equity markets, one of the reasons we haven't seen the ability for a rebound, and we had another attempt last week, is because we don't know when the Fed's tightening cycle is going to end. As soon as the Fed gives us even a hint that they're ready to pause, and I don't mean cutting rates, but I mean just stop raising rates or raise rates very slowly, I think that would be the spark that could get equities on track again. But unless we get some solid indications that inflation is coming down, I'm not sure that's ready yet.
Yeah, well, it'll be nice to have some rationale return to the market, that's for sure.
Yes.
Let's talk about earnings season. We're finally here. We kind of had that lull of the 3 to 4 weeks. We're in that earnings season vacuum. Kicks off this week with the big banks. What is going to be key for you out of these earnings reports, whether it's the big banks, industrials, tech, of course, we're focused on with the Nasdaq 100 names. It seems as if it kind of all comes back to what supply chain and how strong the consumer is.
Yeah, all of those things are factors. So let's look at earnings season in a whole. Last quarter, we had about 7% earnings growth and about 13% revenue growth. The expectation for this quarter, for Q2, is for only about 4% earnings growth and about 10% revenue growth. Now, revenue growth is easy in a high inflation environment because high inflation means everything costs more, and that means revenues are going to be a lot higher. But the difference between the top line and the bottom line is margin, and margin is where you get hurt. So if we have high revenue count this quarter, I wouldn't be surprised by that because that's very, very inflation sensitive. Again, that's nominal revenue growth. But, earnings are more about sort of real growth. In other words, what's left over? What's the margin? And those numbers are likely to be weak because for the most part, whether you're a manufacturer or a servicer, you've been able to pass some of those increased costs on to consumers, but not all of them. And I think that's why we're seeing this compression in earnings. A 4% earnings growth would be positive, which is a good thing, but it's definitely would be the lowest we've seen in a very, very long time. Now, as far as banks go, yes, this week we get, I think, 4 of the major banks. I think it's JP Morgan, Morgan Stanley, Citibank, I think, and Wells Fargo, if I remember correctly, are all going to announce this week. What I think we're likely to see is that their interest margins are way up, and that makes sense. When interest rates go up, regardless of what the spread does, they can charge more on loans, which are increasing in demand, and they don't have to raise what they're paying on savings as much. And so that difference between what they pay and what they charge ultimately gets wider when rates go up. So they should have a nice boost in interest rate revenue. In other words, interest rate margin. Where they might see a decline, especially in those that have a trading aspect, is in trading volumes, because trading volumes in general have been going down all quarter because of this terrible market funk that we're in. I mean, it started to go down a little bit in Q1, but it really accelerated to the downside in Q2. So, but I think the interest rate margin is liable to offset, and then some, probably the decline in trading revenues.
And Randy, it feels as if it's not quite as volatile over the past couple of weeks that we saw it really in the height of Q2. Is there anything that you're seeing in VOLQ or any of the other volatility indexes that suggest things might have quieted a bit for the summer?
Well, yeah, if you look at VOLQ just in general, you can kind of see that. Over about the last month, you can see that the average level around 30, 31 or so. But if you go back to Q2, it actually was more like about 35. And of course, you can calculate, a daily change in, or an expected change, if you will, or an implied move in the NDX on that is 290 points or so. That was more like 325, 330 back in Q2. So just in general, yes, volatility has calmed overall all across the markets. We're obviously still well into a bear market, but the NDX down almost 30% at one point, I think down only about maybe 28 or so now. So it's off the bottom. And in fact, most of the broad market indices are off of their bottoms, and they're just kind of marking time going sideways. I would say probably at least until we get that next Fed rate hike, which is still about 2 weeks out.
All right, Randy, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
You're welcome.